DTI, or debt to income ratio, lets lenders know how much money you owe your debts compared to how much money you earn your income, which helps them determine whether you're financially secure enough to add a mortgage to your current obligations. Now, you could have a good credit score, stable earnings, and a great bill-paying record, but if your monthly debt repayments already eat up too much of your income, a lender might consider you too much of a risk to take on a mortgage. Now, there are two types of DTI, front end and back end. Front end DTI is the percentage of your monthly income that goes towards housing expenses such as rent, mortgage, property taxes, and insurance. So it only takes into account your housing expenses and doesn't consider other debts such as credit card payments, car loans, or student loans. To calculate front end ratio, you add your total expected housing expenses. This includes the principal, interest, mortgage payment, taxes, insurance, and any HOA dues. Dividing your housing expenses by your gross monthly income, you then multiply that number by 100. This total is your front end DTI. For example, let's say your monthly mortgage payment is $1,500, which includes taxes and insurance, HOA dues, all this fun stuff. We're looking at $1,535 a month divided by your gross monthly income of $6,000, and equals 0.2558 times 100 is 25.58%. Now, ideally, this number should be below 28%. Back in DTI, on the other hand, is the percentage of your monthly income that goes toward all your debts, including housing expenses, loans, credit cards, and any other monthly debts, minus utilities. Now, to calculate your own back-end debt-to-income ratio, you add up your total monthly bills and make sure you include monthly rent or mortgage payments, loan payments, credit card minimum due payments, and any child support or alimony payments. You divide the total from step 1 by your gross monthly income, which is your income before taxes. You multiply the number by step 2 by 100, and this total is your back-end DTI. Now, the lower the DTI, the better your odds are for being approved for new credit. So, for example, your monthly debt equals $3,500 divided by your gross monthly income of $8,000, which is 0.4375 times 100 is 43.75%. This DTI ratio is about 44%. Ideally, this ratio, your back end, should always be below 45%. Why is it essential to know about these two types of DTI? For starters, lenders look at both front end and back end DTI to determine if you can afford to take on any additional debt. They typically want to see a front end DTI of no more than 28 to 36% and a back end DTI of no more than 45%. But these percentages can vary based on the loan program for which you qualify, so be sure to check with your lender. Now, if your DTI is higher than the recommended ranges, it means you're spending more of your income on debt payments and you might be considered a high-risk borrower. It could result in higher interest rates, stricter lending criteria, or even being denied a loan altogether, which is why it's crucial to keep your DTI as low as possible. You can do this by paying off debts, increasing your income, or so easy, or reducing your monthly expenses.